Video script, when math becomes fantasy. Price prediction reality. Duration 20 minutes. Sections 8. No visible headings in delivery. Ready for voiceover. Continuous flow XRP could hit $215. That's the prediction circulating right now. Not $10, not $50, $215. And the math looks convincing. If half the world's cash gets tokenized and XRP captures 10% of that market, the numbers work out. Clean, logical, inevitable. Except there's a problem. That prediction requires 5 separate things to happen perfectly. Global money supply continuing to expand, tokenization reaching 50% adoption, XRP winning 10% market share, institutional demand creating price stability at those levels, and all of this happening on a timeline that benefits current holders. Every single one of those assumptions is massive, and they're stacked, which means if anyone fails, the whole prediction collapses. But when you see $215, your brain doesn't calculate the probability chain. It just sees the number, and that number does something to your decision making. If you're here because you want to understand how predictions get constructed and why they're almost always wrong, subscribe. Because what comes next is going to change how you evaluate every price target you ever see again. Let's break down the assumptions. Let's start with the foundation of this prediction. The global money supply. It's currently around $118 trillion. It's been growing at 7% annually for 25 years. Since COVID, 44 trillion was added. That's the fastest monetary expansion in history. Those numbers are real. The growth is documented, and the assumption is that this trend continues. More money printing, more liquidity, more currency in circulation, and as that money supply grows, more of it will be tokenized, put on blockchains, represented as digital assets. The prediction assumes 50% tokenization. That means $59 trillion of the global money supply would exist as tokens, not eventually, not over decades, but within a time frame relevant to current investors. Let's say 10 years. That's assumption 1. And it's already enormous. Tokenization is growing. But going from almost nothing to 59 trillion in a decade requires infrastructure that doesn't exist yet. It requires regulatory frameworks that aren't finalized. It requires institutional adoption at a scale we haven't seen. It requires legacy systems being replaced or integrated, and it requires all of this happening faster than any previous financial infrastructure transition in history. Is it possible? Sure. Technology can move fast. But probable? That's a different question. And when you're making investment decisions, the difference between possible and probable is everything. Now let's add the second layer. XRP capturing 10% of that tokenized market. 10% of 59 trillion is 5.9 trillion in market share. That would make XRP the 3rd or 4th largest financial asset in the world by total value moved through the network. Why 10%? Because the math works out to $215 per token. But let's think about what 10% market share actually requires. It means XRP becomes the dominant bridge asset for 1/10 of all tokenized value transfers globally. Not second place, not niche use case, dominant. That means beating or coexisting with every competing technology. Central bank digital currencies, SWIFT upgrades, other blockchain protocols, traditional banking rails that get modernized, stablecoins issued by governments or major tech companies. All of these are also competing for transaction flow in the tokenized economy. XRP has advantages: speed, low cost, established relationships with some financial institutions. But advantages don't guarantee market share, especially not 10% of a $59 trillion market. Markets are competitive. Early leads get eroded. Better technology doesn't always win. Network effects matter. Regulatory favoritism matters. Political decisions matter. So assumption 2 is that XRP not only competes, but wins big. And that's before we even talk about whether Ripple, the company, can execute at the scale required, whether regulatory clarity actually favors their model, and whether institutions choose XRP over alternatives that give them more control. Third assumption. Price stability at $215. This one is subtle but critical. The prediction isn't just that XRP reaches $215 and immediately crashes. It's that the price stabilizes there because that's the level required for the asset to function as intended. Here's the logic. If XRP is moving trillions of dollars in value, it needs high liquidity. If a bank wants to move $100 million using XRP as a bridge, the market needs enough depth that the transaction doesn't cause massive slippage. That requires either enormous trading volume or a high stable price where large holders aren't constantly selling. But price stability at $215 means something very specific. It means the market has absorbed all the selling pressure from people who bought at lower prices. It means early holders, retail speculators, and Ripple's own massive holdings have either sold or are holding long-term. It means new buyers at that price level believe it's fair value, not a bubble. Think about what that requires psychologically. If you bought XRP at $1 and it hits $215, are you holding or are you taking life-changing profits? If millions of holders face that decision, what does selling pressure look like? How does the price stabilize when everyone who's been waiting for years suddenly has the exit they dreamed about? This is where predictions break down. They model the math of market cap and transaction volume. They don't model human behavior under conditions of extreme profit. And human behavior is what actually determines whether a price level holds or collapses. Fourth assumption, the timeline. This prediction doesn't say XRP might reach $215 in 50 years when we're all retired and the world is unrecognizable. It implies a time frame that matters to people watching videos about it today, which means 5 years, maybe 10. But institutional adoption doesn't work on retail investor timelines. Financial infrastructure changes slowly by design. Banks don't switch payment systems because the technology is better. They switch when the risk is lower than the cost of not switching. And that calculation takes years. Central banks are still exploring CBDCs. They've been exploring for a decade. Tokenization pilots are running, but pilots aren't deployment. Swift has been trying to improve for years. Legacy systems are sticky because they work, even if they're inefficient. The cost of transition is high. The risk of failure is high. The incentive to wait and let others test first is strong. So the timeline assumption is that all the technological, regulatory, and institutional pieces come together fast enough that current XRP holders benefit, that the gap between now and $215 is short enough that people don't lose patience, don't need the money for something else, don't get shaken out by volatility, and don't rotate into other opportunities. That's not impossible. But it requires everything going right. And markets are not environments where everything goes right. Markets are environments where most things go wrong, a few things go right, and timing determines who profits. Now let's zoom out and look at what these stacked assumptions actually represent. They represent a best-case scenario, not a likely scenario, not a median scenario, best case, where every variable breaks favorably, where competition doesn't disrupt, where regulation doesn't restrict, where technology doesn't fail, where adoption doesn't stall. Best-case scenarios are useful for understanding potential. They're not useful for making investment decisions, because investment decisions need to account for the range of outcomes, not just the top end. Here's an analogy. Imagine someone telling you that if you start a business, work 80 hours a week, make perfect decisions, hire the right people, avoid all major mistakes, and get lucky with timing, you could build a $100 million company in 5 years. All of those things are possible. People have done it. But that doesn't mean you should assume you will. Most businesses fail. Most that survive don't reach 100 million. And most founders who reach that level will tell you luck played a bigger role than they expected. Same principle applies here. XRP could reach $215. The math works if the assumptions hold, but the assumptions are best case, and best case almost never happens. Most of the time, some assumptions hold partially, others fail completely, and the outcome lands somewhere in the middle of the range. So a rational analysis doesn't ask, could XRP reach $215? It asks, what would need to happen for that outcome, and how likely is each step? Understanding the difference between what's mathematically possible and what's actually probable is the foundation of critical thinking, about financial claims. Most people conflate the two. They hear a prediction with math behind it and assume it's a forecast of what will happen, not just what could happen under perfect conditions. Here's the psychological trap these predictions create. Big numbers are sticky. Once you hear $215, your brain anchors on it. Even if you consciously know it's speculative, the number sits in your mind. It becomes the reference point, and that reference point affects how you perceive subsequent information. You start thinking, if it could hit $215, then $20 is nothing. $50 is still early. And that logic changes how you interpret price movements in news. It makes you filter information through the lens of that extreme target. This is called anchoring bias. And it's one of the most studied cognitive biases in behavioral economics. Because once you're anchored to an extreme reference point, every piece of information gets processed relative to that anchor, even if the anchor was arbitrary or unrealistic to begin with. The people who create these predictions know this. Not maliciously, but they know big numbers get attention. They know ambitious targets generate clicks, views, and engagement. They know people want to believe in exponential returns, so they build models that produce exciting numbers, and they present them with enough math and logic that they seem credible. But credible sounding and accurate are not the same thing. A prediction can be logically constructed from valid assumptions and still be completely wrong because the assumptions don't play out. And in markets, assumptions almost never play out exactly as modeled. So what's the better way to think about this? Instead of asking what XRP could be worth if everything goes right, ask what has to happen for it to be worth more than it is today. Break that down into concrete, measurable milestones, and then think about the likelihood of each milestone. For XRP to increase in value sustainably, you'd need some combination of these factors. Regulatory clarity that explicitly allows institutional use of the token. Not just Ripple, the company, being legal, the token itself being usable in regulated financial systems. Real transaction volume growth, not theoretical capacity. Actual banks and institutions processing real payments through XRP at increasing scale. Market structure maturation. More liquidity. Tighter spreads, deeper order books, reduced volatility, tokenization adoption expanding, real-world assets actually moving on-chain at scale, creating genuine demand for bridge assets, and time, because even if all those factors develop, they develop slowly. Each of those is a hurdle. For the price to reach higher levels, multiple hurdles need to be cleared, and at each stage, the requirements become more demanding. The path to extreme valuations is narrow. It requires specific conditions. Understanding this doesn't tell you what will happen, but it helps you evaluate claims more clearly. It separates mathematical possibility from real-world probability. Here's the final reality check. Predictions like $215 serve a purpose, but it's not the purpose most people think. They're not forecasts. They're thought experiments. They're attention mechanisms. They get people excited about possibilities. They keep communities engaged. They attract new participants who hear big numbers and want to learn more. And that's fine as long as you know that's what they are. The problem is when you mistake them for certainties, when you treat best-case scenarios as expected outcomes, when you assume mathematical models reflect reality instead of simplified versions of reality. Understanding financial claims requires separating what could happen from what's likely to happen. It requires recognizing that models rest on assumptions, and assumptions are where predictions break down. That's the skill worth developing, not memorizing price targets, but learning to evaluate the assumptions underneath them, learning to recognize when logic is sound, but premises are questionable, learning to think clearly about uncertainty instead of pretending it doesn't exist. If this changed how you think about crypto price targets and the assumptions underneath them, subscribe. We're here to teach you how to think critically about financial claims, not what to believe about any particular asset. Drop a comment if you've ever noticed yourself anchored to an extreme prediction. Let's talk about how cognitive biases shape how we process information about financial markets. Because the most important skill isn't predicting the future. It's understanding how predictions are constructed, what they actually mean, and how to evaluate them clearly. Critical thinking about financial claims is built on recognizing uncertainty, questioning assumptions, and understanding the difference between mathematical possibility and real-world probability, not on hoping specific outcomes happen because someone built a model that says they could, and will are different universes. And clear thinking requires staying grounded in what's known, not what's imagined.